Valens Research, Uniform Financial Analytics.
Square, I'm sure all of you know, right? The payment processing business founded by Jack Dorsey, same guy who founded Twitter, right? When we look at Square, two things jump out that are really interesting. One is on this chart, but I'd actually rather spend time on this chart that's going to load up here in a moment, which is actually looking at it on an EPS perspective. One of the things that's really important is we think the most relevant way to look at a business is looking at return on assets and asset growth. We think it's a great way for you to break apart free cash flow and earnings growth into its two parts that are so important. However, we understand a lot of people look at PEs and EPS growth. And so we also have the ability to show those things on uniform accounting, and we look at that data. What's really interesting about Square is if you looked at Square on an as-reported basis, 2019 to 2020 should have been a banner year for Square. Right? 2020, Square does digital payments. Who doesn't want digital payments when you're in the middle of a pandemic? On an as-reported basis, though, you would have thought Square saw EPS fall by 40 cents and by almost 40% from 2019 to 2020. You'd be like, whoa, they have not successfully transitioned into the digital economy as much as they claim to. In reality, though, in a challenge year for retail, they were able to actually see EPS grow slightly in the last 2 years, not see it decline, and it's forecasted to accelerate even more from 2020 to 2021. And right, the company, well, it is expensive, is trading at half of the multiple on an as-reported basis you look at. You can see it using the uniform accounting versus as-reported ROA too. On an as-reported basis, you would think that Square had a negative ROA every single year for the last 5 years. In reality, every single year for the last 5 years, Square has had positive ROA. It's been a profitable business. You wouldn't even realize that looking at as-reported metrics, and you would think you're valuing a startup, and not even just a startup that's having a profitability misstep because earnings are falling, not rising, which is what it should happen for a startup. You would totally misunderstand this business and not even pay attention to reality for it, right? And not understand why it is the market is pricing the hockey stick it is, because the market knows it was already a profitable business, and as digital payments continue to accelerate, it's entirely possible that it continues to see ROA ramp.
Valens Research, the world's leading source for uniform financial analytics.